Hey value investors, thank you for joining me. Right now we're going to get into a stock, go over some graphics. Before we do that, just want to say, check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you which stocks I own and why. I'll give you balanced arguments for the stocks I own. What's more, I come up with one new investment idea a month, so you can do a totally free trial to see if it's for you. Deep Value Returns on Seeking Alpha. Let's get started. Hey value investors, thank you for joining me. Right now we're going to talk about Microsoft. We're going to discuss its revenue growth rates. Then we're going to talk about its different segments. Then I'll move on to the theme of the digitalization of the future. Moving on from that, we'll talk about free cash flow and whether that still matters. Then I'll come into the valuation of Microsoft and whether there's still upside potential. And at the end, I'll talk about an investment risk. So let's get started. Revenue growth rate is going to come down to about 8% for Q1 21. Now, that is not great, and the market probably didn't like that too much, but ultimately, I don't think that's a huge problem because Microsoft is not supposed to be a high growth stock. You just need it to kind of tick along over time, and because it just has so much free cash flow, which I'll address in a moment, it just really you can buy a lot of shares back. There's a lot that can happen when a company literally oozes free cash flow. Right now, we're gonna go on to talk about its segments, and everyone is obsessed with Microsoft Azure. Azure is here. It's inside of the intelligent cloud, and Azure for Q4 2020 came up at 50% year-over-year growth. But I haven't really shown here, but the three segments are very, very proportional. So each one is very much kind of close to 33% on terms of revenue. So it breaks down quite easily, but it's intelligent cloud that everyone's obsessing about. And intelligent cloud is still going to kind of plow ahead, but you don't need to just think about one little business unit within this segment here. Microsoft is Xbox, Microsoft is obviously Office, it's so much. It's really what I wanted to talk about is the digitalization of the future. So thinking of Microsoft like a bond on the future. So what Microsoft has got is that distribution. It's like that brand. When it comes to enterprises, that's where the real money is, right? The money is on enterprise and being able to monetize enterprises and the movement of the workforce into the digital environment. So it's that theme that, when you think about Microsoft, it's about how to get a bond on the future. That's what I think about. So it's not really about a high growth, jazzy stock. It's just really about how, as workforces continue to migrate on their digital journeys, how do you monetize that? Because we saw that during the COVID crisis, that trend towards remote working is coming, and it's just which companies are going to be the winners, and that's a very difficult game for value investors. Value investors are basically trying to do the opposite. Rather than trying to pick out the winners, they're just trying to buy at a discount the future free cash flow of the company, and that neatly drives me towards cash flow. So many companies right now are high-flying, unprofitable companies, and there's really no path towards profitability. They will claim there is, but there is really no path. In the case of Microsoft, it's the opposite. They've got so much free cash flow that they're always under some kind of antitrust infringement rules or some kind of lawsuits against that, because they're just a monopoly essentially, and it's very, very difficult for them to keep just growing that. But at the same time, they do. I mean, you can't explain it any other way apart from Microsoft just oozes free cash flow. And with that, they pay a small dividend, which is approximately 1% yield, but they do also buy back a ton of their shares. So this one is just for buy and hold investors, and I think that it can do quite well over time. So let's move on to this here. So I am very, very, very late to the Microsoft game, and I might sell out of Microsoft at any point without giving you any notice. But I think that this is worthwhile buying, even though as we discussed above, we can see here that the revenue growth rate for Microsoft is coming down to approximately single digits, while at the same time, the multiple that investors are willing to pay continues to neatly expand over time. But I think that at approximately 12 times multiples to sales, I think that there's still a lot of potential, because if I look elsewhere in the market, I see this trend happening everywhere. It could be the low interest rates, it could be that the investors are just paying a large multiple for anything that has a future capacity to be relevant in the cloud environment. It could be that just the index funds are just buying all these kind of high-flying stocks. So I cannot explain where the market is headed, but I just don't think that paying 12 times sales, even this late stage Microsoft, is exuberant. I think that even though the market didn't like the report, didn't like the earnings call, the stock sold off 2%. I don't think that's a big deal. I think that given the run-up that it's had since March, I think that's just fine. I don't think that's a big thesis breaker. I mean, it's fine. Now, just wanted to talk about very briefly about Slack. So Slack trades at 25 times sales, unprofitable sales. On the other hand, Microsoft trades at 33 times earnings, and those earnings are just going to keep growing over time. It's just unquestionable. So I think that many investors really like Slack, but I think that Microsoft could do better. Finally, an investment risk. So the biggest risk that I can see for Microsoft is whether it can consistently grow its revenue growth rate. If it can continue coming around high single digits, then I think this can work out quite well. You just buy back your shares and you just keep ticking along, and you'll do better than the market as a whole. The market typically does 10%, and if you get in roughly high single digits on the revenue growth rate and you buy back a ton of your shares, that means that the EPS at the bottom line can at least grow at 15% minimum. Realistically, in the past, it's grown closer to 25%. But I think that even, being super conservative, right now the investor can get at least 15% over the next few years. So I think that's quite attractive. I hope you found this video useful. Don't forget to subscribe so you can get my next value installment, and check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll see you next time. Bye.